Hey everyone, and welcome back to the channel. Today we're diving deep into the minds of two absolute legends in the trading world, Minervini and David Ryan. Both are former US investing champions, and their strategies have generated mind-boggling returns for decades. They literally turned a few $1,000s into millions. So how did they do it? What are the core principles that separate them from the average trader? That's exactly what we're going to break down. We're going to distill their combined wisdom into actionable rules that you can start applying to your own trading right away. Forget the get-rich-quick noise. This is about building a professional, disciplined approach that stands the test of time. Ready to learn from the best? Let's get started. The very first, and perhaps most important rule from both Minervini and Ryan is this: know when to sit on the sidelines. This leads directly to the second golden rule. Always control your risk. This is non-negotiable. Both traders are obsessive about avoiding large losses. Before you even enter a trade, you must know exactly where you will get out if you're wrong. This is your stop loss. For Minervini, the maximum loss he's willing to take on any single trade is typically around 5 to 6%. But he often cuts losses much sooner, at just 2 or 3%, if the trade isn't acting right. He says, the secret to winning in the stock market is not to lose. It sounds simple, but it's profound. Big losses are what knock you out of the game. They require huge percentage gains just to get back to even.
Nice.
If you lose 50% of your account, you need a 100% gain just to break even. By keeping your losses small, you ensure you live to trade another day. This isn't about being afraid to lose. It's about making sure your losses are mathematically insignificant in the long run. Now, let's talk about what to trade. Rule number 3 is to trade only consistent and proven setups. You need a playbook. You can't just buy stocks because you have a good feeling or because you read a news headline. Minervini is famous for his VCP, or volatility contraction pattern. This is where a stock's price range tightens from left to right on a chart, indicating that supply is being absorbed before a potential major move higher. David Ryan, who is mentored by the legendary William O'Neill, looks for classic cup and handle patterns, flat bases, and stocks that are showing strong relative strength compared to the overall market. The key here is specialization. You don't need to know every pattern under the sun. You need to master a few high-probability setups that you understand inside and out. You should be able to recognize your A-plus setup instantly. This focus gives you an edge and builds the confidence to act decisively when your pattern appears. Don't be a jack of all trades, a master of one or two. So you've found your setup. You've entered the trade, but it immediately starts going against you. What do? This brings us to rule number 4, one of the biggest sins in trading. Never, ever average down on a losing position. This is a game ender. When you average down, you are essentially reinforcing a bad decision. You're throwing good money after bad, hoping the stock will turn around and prove you right. Hope is not a strategy. Professional traders deal in probabilities, not hope. If a stock hits your predetermined stop loss, you exit. Period. No questions, no hesitation. David Ryan has said that adding to a loser is like watering your weeds and cutting your flowers. A losing trade is a signal that your initial thesis was wrong. The market is telling you something. Listen to it. Accept the small loss and move on. And your ego is your worst enemy here. The goal is to make money, not to be right on every single trade. Okay, let's flip that around. How do you get in and out of winning trades? Rule number 5 is about timing your entries and exits with precision. You want to buy at the point of least resistance. For both Minervini and Ryan, this often means buying on a clean breakout from a proper base, ideally on a surge in volume. This volume surge acts as confirmation from institutional investors that they're also interested. Don't chase a stock that is already way up and extended from its base. It's called buying high and selling higher, which is a risky game. If you want to buy at the pivot point, the exact moment it's launching. Now, for selling, this is often the harder part. A common strategy they use is to sell into strength. As a stock becomes parabolic or extremely extended from its moving averages, it's time to start taking profits. Don't wait for it to top out and turn around. Sell while the buying is still frantic. You'll rarely sell at the absolute top, and that's okay. The goal is to capture the fat middle part of the move, not the very beginning and the very end. This next rule is critical for maximizing your account's performance. Rule number 6. Aggressively rotate out of weak positions and into strong ones. Your capital should always be working for you in the best possible opportunities. If you have 5 stocks and 2 are performing brilliantly while 3 are just chopping sideways or slowly bleeding, what should you do? Most amateurs will sell their winners to lock in a profit and hold their losers, hoping they'll recover. This is the exact opposite of what you should do. Minervini and Ryan do the reverse. They cut the laggards the weeds and may even add that capital to their strongest performers the flowers. This concept of feeding your winners and starving your losers is a cornerstone of portfolio management for trend followers. Don't get emotionally attached to a stock. If it's not performing, it's dead money. Your job is to be a ruthless manager of your capital, constantly reallocating it to where it can generate the highest returns. Rule number 7 might surprise you if you believe in wide diversification. The rule is to focus on just a few high-quality positions. Both Minervini and Ryan run relatively concentrated portfolios. Instead of owning 50 or 100 different stocks, they might focus on just 5 to 10 at any given time. Why? Because your best ideas are the ones that will make you the most money. Spreading your capital too thin, or diversifying, as Peter Lynch called it, means that even when you have a huge winner, its impact on your overall portfolio is minimal. By concentrating your capital in a handful of A-plus setups, you give yourself the potential for truly explosive returns. Of course, this only works if you are absolutely ruthless with rule number 2, controlling risk. Concentration without strict risk management is a recipe for disaster. But when combined with disciplined stop losses, it's a powerful way to compound your account rapidly. Finally, let's talk about how to manage a position once you're in it. Rule number 8 is to scale in carefully and protect your gains. You don't have to go all in at the breakout point. A smart approach is to start with a partial position, say 1/3 or 1/2 of your intended size. If the stock immediately moves in your favor and shows strength, you can add to your position. Minervini calls this pyramiding, but you only add to a winning trade, never a loser. You add more as the trade proves you right. As the position moves further into profit, you must protect those gains. A simple way to do this is by moving your stop loss up to your break-even point once the stock has moved a certain amount in your favor. Now, you have a risk-free trade. From there, you can use a trailing stop, perhaps based on a key moving average like the 10-day or 20-day, to let the winner run while still protecting the bulk of your profits. This allows you to stay in a strong trend for as long as possible without giving back everything you've made. So there you have it. 8 powerful, time-tested principles from 2 of the greatest traders of our time. Let's do a quick recap. 1. Sit out when conditions are poor. 2. Always control risk and keep losses small. 3. Focus on consistent, proven setups, or never average down on a loser. 5. Time your entries and exits with precision. 6. Rotate out of weak stocks and into strong ones. 7. Concentrate on a few high-quality positions. And 8. Scale in carefully and protect your profits. If you notice, there's a common thread running through all these rules: discipline. Trading success isn't about finding a magic indicator or a secret formula. It's about developing a sound methodology and having the discipline to execute it flawlessly, day in and day out. It's about managing risk, managing yourself, and letting the market do the heavy lifting. Start by mastering 1 or 2 of these rules. Make them a habit, and then build from there. I promise it will transform your trading results. Thank you so much for watching. I hope you found this breakdown valuable. If you did, please hit that like button and subscribe to the channel for more deep dives into the strategies of the world's best traders. Let me know in the comments which of these rules you're going to focus on first. Till next time, trade smart and stay disciplined.